Hi guys, thanks for tuning in to a special edition of the Ask Nugget show. We've been getting a lot of questions about how Bitcoin's going to perform in a stock market crash. What does rising interest rates mean for Bitcoin? Is there a correlation? And my answer this morning, that tweet I put out that Bitcoin had held up really well on a day where the stock market had plunged, well, that all changed a few hours later. And I want to talk about why that is and if we can expect that to happen again in the future. And it's funny, and get out your tinfoil hat. We've been looking at this article all week. What's going to happen on 10/10 October? And then we see this big red day on stock markets, and then cryptocurrency follows. So today, the US stock markets had one of their worst days since Trump's been elected. And if you go off the Dow Jones Industrial Average, this was the third worst point decline in history. Now, that's a little bit of a misrepresentation because in terms of percentage drops, we've had some far bigger moves throughout stock market history, but still pretty significant. That's a big red candle. The Dow Jones is a mix of 30 of the largest US companies, but it was across all markets. The S&P 500, the NASDAQ, which encompasses all those tech stocks, Russell 2000, all these were down. And we see here we had a bit of a bounce at the 200-day moving average, but now we've actually pierced that lower. But I don't want to talk too much about stock markets. I want to tie this all together, with gold, bonds, interest rates, and Bitcoin. So we saw volatility spike. This is VIX, the volatility index. Stock markets, as a general rule, over the past few years just haven't been fearful. They just don't think that there's a big correction coming, and they haven't been very volatile. And we see that this quickly jumps from 11 to 22, doubling in a few days. And for you traders out there, there's a few different ways you can play this. UVXY, I think TVIX is another one, but I'm going to talk a little bit tonight in a members video about ways to play this. But for the purpose of this video, I just want to try and tie this together with interest rates. So 1980 isn't that long ago. I'm sure a few of you watching were trading back then as well, when interest rates are around 20% in the US, and they've just been decreasing over time as central banks lower interest rates, try and spur economic growth. The theory is that if you can get no interest on your money in the bank, you'll go out and spend it. And it's the same for central banks lending to banks. They want to encourage them to give money out and spur loans and innovation and give out mortgages and all. That's the sort of theory behind how lowering interest rates work. Now, I'm not going to dive into economics because there's plenty of people that disagree with that theory. But for 10 years, we've basically been near zero. And now, just lately, the US have started to aggressively raise interest rates. And there's talk that they'll be, back up above 3.5% as soon as next year. And this is a pretty similar story around the globe. In Australia here, it was in the 1990s, we had interest rates above 15%. Imagine being able to get that rate of interest on a bank account. And we've been at around 1.5%. But in Europe, they even got as low as negative, where they would punish you for having money in the bank. They really were forcing you to go out and spend money. Again, I don't want to talk about that too much, but let's just have a look at bonds, because the bond rate got above 3% on the US 10-year Treasury, and only last year, or even the start of this year, it was around that 2.4% mark. So imagine this as that savings account example. You can get 2.4% on that, and now you can get 3.2%. So a huge increase. And if I've got a bond that was only giving me 2.4% and now I can get 3.2%, what am I going to do? Well, I'm probably going to sell it and buy the bond that has the better deal. And that's what we've seen. This is why bond prices of the actual underlying asset goes down, because people are selling them off. They believe there's a better deal in the future. So that's just a quick explanation to bonds, but that they are the biggest market in the world. Now, if I can get a guaranteed 3% on a US bond, I'm less likely to be pumping more money into the stock market, particularly if they're at record highs. I think, geez, is the stock market, there's a fair bit of risk there. I can get over 3% with no real risk. I'm going to pump it into higher interest rate bond environment or term deposits or other assets. So that's kind of how this all starts to tie together. But the debt is the big factor that is at record levels. So 250 trillion is the number we're seeing come out in 2018, and debt is at a higher level than the 2008 financial crisis. Whether we're talking about households, financial sector, government debt, public or private, you can cut this however you like, guys. But the fact is, interest rates have been near zero around the world. And now we're on our way up, we're marching higher. And I want to give you some real world examples to really clarify how interest rates can affect everything from your credit card to housing. And it's the same underlying principles that affect governments, corporations, bonds, everything. So let's go over and check out some real world examples here. This is an $800,000 mortgage. If you're living in Melbourne and Sydney, this is what you're looking at these days to buy a family home anywhere near the city. Now, with current interest rates at 4.1%, I'm just on the CommBank interest rate calculator here. If you want to borrow that amount of money, you're looking at around $3,800 a month as your repayments. You end up paying $1.4 million over the life of the loan, $600,000 in interest. Now, if interest rates jump to 7.1%, that's only a 3% increase there. Look how much you're paying extra. You're almost paying $2 million over the life of the loan. You're paying almost double what you were before. You're now paying $1.1 million just in interest. That monthly figure has really stretched you. If you were only just being able to afford your principal and interest, now you're all of a sudden $1,500 underwater. So that shows you just quickly how these realistic numbers can really stress some people out. And we're relying on the banks when they do these tests. And what we've found in the Royal Commission here in Australia, and it was the same in the US, that often we have these lie loans where people lie on their form, or banks will, turn a blind eye to certain conditions and give these loans out to people that maybe couldn't afford them because they were getting incentives. And there's all this sort of foul play. And it's all well and good in the short term, everything looks rosy, but it's when interest rates rise and the rubber hits the road, as you hear me say, that things can get messy pretty quickly. So let's go have a look at the same example. How much is that $800,000 loan theoretically worth if that person can only afford to pay that initial $3,800 a month? They can't actually afford to pay this new amount. And this is how my brain works when people talk about housing correction. It's been impossible. But guys, a lot of people say a house is only worth what a bank will lend you. So if you're telling the bank that I can only afford this monthly repayment of 3.8, all of a sudden your house, the amount that they will let you borrow comes down to $578,000 from that initial $800,000 amount, if that interest rate is at the new higher standard. So again, this is just all stuff to think about, that theoretically the same person earning the same amount, paying the same amount each month, this is all they can now borrow. Does that mean that that's all the homes become worth if interest rates rise from just 4.1 to 7.1%? So hopefully that's a good real world example that clearly demonstrates some of those principles. In the US, the thing that brought down the housing market and the global economy was these ninja loans. So they're giving out loans to people with no income, no job, and no assets. And that's just insane as it sounds. Hopefully things aren't that bad here in Australia. We know there has been some issues, but I wanted to highlight that this is an issue not just in housing markets, credit cards, short-term loans, the shadow banking system as they call it. A lot of people now can ring up and get $5,000 or $10,000 loans, with just a phone call or clicking a few buttons on a website. And it's just this huge amount of global debt, as I said before, that some people are going to find themselves very quickly underwater. So compound interest can be powerful to the upside as well. I know we spoke about in an episode last year, if you've got $10,000 in your trading account and you can just make 10% a month, and this doesn't have months, guys, in the calculator, so let's just go for 48 years, but let's pretend that there are months there. Let's click on that. So over 4 years, which is 48 months there, by just making that 10% trade, you can turn $10,000 into $1.2 million. Pretty powerful stuff. And especially when you consider, last year we were on an amazing run with, I think, 44 winners and 1 loser, and you can turn that amount of money into this amount of money. So you've got to risk it all. I don't want to dive into that too much, but compound interest is a powerful thing. It can be your friend if you avoid large drawdowns to the upside. That's all I wanted to illustrate there. But it can also be your worst enemy. So if you've got a credit card debt, and in Australia we see these crazy interest rates, 18% if you don't pay them on time, by paying the minimum, you could end up taking 43 years and 11 months to pay down that $10,000 owing amount versus if you're paying the highest amount, $1,000, and you can pay this down over 11 months. So let's say you've actually got $25,000 debt on your credit card. Again, it can end up costing you $94,000 if you're only continually kicking the can down the road, paying those minimum repayments, and you don't want to take 60 years to pay back $25,000 credit card debt versus paying that maximum amount, guys. So this is the thing that often catches out people that aren't financially savvy, that think, oh yeah, I'll just pay that off gradually. Then they get this surprise bill in the mail. All of a sudden they can barely afford to pay the interest, let alone the principal that they're trying to pay down. And this is how it snowballs and people just get trapped in debt. Now, these examples I've given you are housing and credit cards, but this is the same general principle for entire countries. A lot of these emerging market index, as we see here, have been lent a lot of money, or the debt's in US dollars. Now, double-edged sword, if the US dollar gets stronger, which it has been, look at these emerging markets have just fallen off a cliff. They've got to pay back a stronger currency at higher interest rates, double-edged sword, and that's where we can really get in trouble. We don't want to accidentally really strain those economies, which could be the driver of growth. Those emerging markets is where we want, the best population demographics and growth to come from. So that's something to keep an eye on as well, guys. Gold. We don't know how gold is going to react. So during the 2008 crisis and leading into this, gold had been in a stellar bull market, but like everything, people sort of flee to safety. And if you're getting margin calls on all these stock positions and you've got gold in your portfolio, you just have to sell it to get liquidity, to get money in your account and cover your other losses. And that's why we see gold really sold off sharply there throughout 2008. But it was really afterwards when people thought, gee, central banks are going to lower interest rates, print money, worries about inflation. There's no longer a good deal by having money in a bank account, and that's where gold just had that huge run from 600 up to 1900. And since then, it's been in a bear market, a correction. People sort of thinking that central banks have things under control. The Fed has started to raise rates. It's all pretty rosy, but it's going to be interesting to see if everything gets out of control and people have got a lot of faith in central banks, yet they have mucked up in the past. How is gold going to perform? Is it just going to sell off with everything else, or is it going to have its day in the sun? I certainly think that it is long term, because central banks have no real option apart from printing more money and lowering interest rates. We've seen that is what they do every time, guys. They try to raise them and they never quite get up as high as the previous peak. We're on that finite planet. We don't have just these huge exponential growth and fairly unlimited resources that we did back in these periods when the population was a lot lower on the planet. So I think gold's going to have its day, but Bitcoin is the one that we want to see how it's going to perform. And this morning, as I said, look at the stock market when it dropped off the cliff here in these thin red bars. This was hours before Bitcoin was holding up well. Actually, it was going up a little bit there. But then 10 hours later, Bitcoin decided that it was going to sell off. Now, that was really frustrating for me, waking up and seeing that Bitcoin had held up well on a day when there was headlines about stock markets plunging. So I often think, who's behind this? Is it the guys that want to, imprint on you that when stock markets sell off, Bitcoin's going to sell off? Now, it didn't happen straight away, so you can't say it's the, necessarily direct correlation. And I don't want to call it manipulation because it's fair play by traders and whoever's doing this, but yeah, disappointing for me because I don't think that this should have necessarily dropped off a cliff. And, you look down the list here, everything's down around 10%. There hasn't been any bad news for crypto. Why should Bitcoin on crypto fall off a cliff, drop 10%, 10 hours after the stock market's had a correction? It all looks very sus to me. And I don't want this to become the norm where these small group of people can maybe bully the market so that if there's a big stock market crash in future, people, again, they think, oh, geez, that means Bitcoin is going to collapse. Now, if the majority of people holding Bitcoin are those people that need liquidity, as I said in that other example, and they have to sell, but at the moment, I don't think that's necessarily the case. There's a large majority of the Bitcoin ecosystem that is retail investors, people in different countries, people that don't like the US or US stock market. They probably don't have a trading account. people using it in the real world, in Africa or whatever it is, guys. That's that real world demand that we'd love for Bitcoin to be the majority of its use case. We want that to be outweighing the attachment to US stock markets and ETFs and speculation, because if the stock market went into a prolonged correction and Bitcoin could be that uncorrelated asset, that's what we really want for it to succeed. So let me know your thoughts below. How's Bitcoin going to act in a real ongoing stock market correction or bear market? Do you believe this was manipulation for stock markets to fall out of bed and then 10 hours later Bitcoin happens to fall out of bed as well? Interesting stuff, guys. Let me know your thoughts below. Hit that like button, subscribe if you haven't already, share these videos around, and thanks for tuning in, guys. Cheers.